Well, as we know, the jobs number came out, and it was quite depressing to see such a small number as more and more people give up looking for work. So, you know, that 4.7% unemployment rate is just, I mean, it would be laughable if it weren't so tragic, the reasoning behind it. And, you know, I just joked to Gil this morning, you know, maybe we're in not just for negative interest rates, but also a negative unemployment rate. As the Fed works its magic, and you know, ultimately though, things obviously are not well economically at home or abroad, and of course this makes it more difficult for the Fed to go ahead and hike rates. We have a lot of headwinds. The market does, not just the global situation, but within U.S. markets. I mean, we've seen a very steep slowdown in earnings. This we saw also in the year 2000 and also 2007, before the big recessions. We're seeing the same pattern now. The difference, of course, being that we have QE on the front burner and the back burner. And this, of course, can push markets ever so higher because the capital's got to go somewhere. And stocks offer, I guess, the greatest return, certainly not bonds. Bill Gross's PIMCO is quite, Janice's Bill Gross is really quite pessimistic about the risk-reward nature of things. He seems to think that the markets aren't going to go higher ultimately, but I think he's misjudging the situation of QE. QE is don't fight the Feds in plural, and we've seen what QE can do. And you know, maybe we get another 2015 where markets are just sloshing around. It becomes more of a short-term traders market, which is, you know, you can still make progress, just not as much. Although I would think that rather than repeat 2015, and markets don't like to really repeat themselves, we're probably in line for greater volatility, like we've seen earlier this year. That could come, you know, any of these headwinds can rear up and create, you know, sudden knee-jerk reactions to the downside. That's great for the VIX volatility model. It tends to shine during periods like that, especially with the 15% profit-taking rule in place. It doesn't mean, of course, that it takes automatically 15%, but it watches like a hawk, so that 15% doesn't reverse back down to zero like it did a number of times since August when we launched the beta version of it. But at any rate, we are seeing increases in the price of oil, increases in commodities, increases in defensive stocks, utilities, all the signs that the market is potentially topping. It tends to show these signs of prior tops as well, and so you get this effect of added pessimism as a result. The question will be, the QE factor is, of course, a wild card. So you have all these headwinds, which I think they certainly add to the volatility of the markets, but QE ultimately can keep the floor under the market.
Hey, Dr. K.
Yeah.
I just wanted to ask everybody if they can hear everything okay. One person is apparently not getting the sound, so
okay, but just
sure.
one might be that one.
All good. So it seems to me that one person it's their own internet. That can happen. You know, a lot of people run into that problem. Okay, yeah. Continue.
So yeah. So anyway, we have all these warning signs, and of course the markets like to climb the wall of worry, and this is a QE wall of worry. And you know, right now we've been bouncing off those lows, and again, this doesn't surprise me that, you know, there's been a lot of signs that the market is seeing things as the glass being half full rather than half empty. So in other words, QE is the ultimate driving force. But as I wrote in a prior report, it's we, because we write everything together on these things. But basically, we have a situation where the markets can easily come apart at the seams, but QE just pushes them higher. So we get this we'll get a lot of volatility in the mix. And when things sell off, as you can see in, look at any major market average, it tends to do so very quickly. So the short selling strategy, it can be very profitable quickly. As we all know, the profits accrue very fast within a matter of a couple of days, 2-3 days, when you hit the stock at the right point. And of course, the BVM, the VIX model, operates in a similar principle when it goes into a buy signal. In other words, it's predicting elevated volatility, which means it's saying that the markets are going to have a short, sharp shock to the downside, potentially. But at any rate, the model right now still sees an uptrend in the markets. Both models do. And right now, it looks like, this, I'm just looking at the way the market's been trading today as a result of the news. And it doesn't look to me like this is the beginning of a downtrend. It looks more like a shakeout of some sort. And with that, I will turn it over to Gil.
Yeah, I don't think you can really tell just yet whether we got a shakeout or a sell-up. It could be either or. But if you look at this, Dr. K, I think like the Nasdaq here, blow this up. Whoops, come on. Get bigger there. There we go. If you look at this, you came up through the 50-day. That's when the model went to a buy signal, and so you run up to the highs. You actually made a new high for the year yesterday. Volume was slightly lighter. It seemed that sellers were not in a big hurry to unload shares yesterday, so buyers just kind of pushed it higher. You made a new year-to-date high, and now you can see you're in an extended position because you're actually up 1, 2, 3, 4, 5, 6, 7 days in a row. So you're extended off the lows pretty much straight up. So a pullback here would be normal, and maybe the hairier it is, the better, and it would bring some stocks back into viable position. And I'll get into some of the stocks I've been trading over the last few days, and some of them have worked very well. But I think it's still the same type of market where you get 10%, maybe 15% moves in stocks. You have to be very opportunistic, and you're not buying breakouts necessarily. In some cases, you will see some breakouts work, but there tend to be far and few between that will produce big gains. The better moves seem to come in less orthodox positions, and that's where you're bottom fishing and roundabout pocket pivots, and then just pocket pivots within the base also become your primary weapons in terms of effectiveness and profit production. But when I look at this, even look at the S&P here, the Nasdaq pulling back, okay, it could come into the 10-day line, 48.92. That's still a ways lower, or it could really get nasty and come all the way down to the 50-day, and you would still sort of be in a range, You could even go all the way down to the lows and test those and move around. That wouldn't surprise me either. So I think it really comes down to watching what individual stocks are doing and being willing to take your shots on the basis of the setup. So it's really kind of the same story and the same thing I've been talking about over and over again. At the same time, recognizing that you're not really in a trending market. But that's kind of been the case for a while because, again, if we look at this, you look at this thing, it just zigs and zags back and forth. Big moves, but those big moves are tradable, as I see it, on a short-term basis, on a so-called swing trading basis, which, swing trading is nothing new. I know IBD is trying to turn it into a product and make it sound like it's something fantastic and wonderful and the road to magic riches, but anybody who's hype mongering stuff, I think, portrays their stuff as the road to instant riches. The market isn't like that, as you guys all know. It's much more difficult. You have to put in a lot more work. Nobody's going to sit there and be able to tell you buy here, sell here, buy here, sell here, and necessarily be perfect all the time. So risk is always present. And I don't see swing trading as something that's brand new, and it's certainly not a trend following strategy, obviously. So the idea that you can use Can Slim, say, as the foundation for a non-trend following strategy or a swing trading strategy is somewhat limiting, because what happens if you're taking a swing trading approach, you can actually rely on a large number of different setups. And I'll give you some examples. Here's one, Palo Alto Networks, the undercut and rally move, or what Richard D. Wyckoff would describe as a spring, which is essentially where a stock undercuts a prior low, and it's either a shakeout. I look at it two ways. I think Wyckoff looked at it as a low volume undercut. I look at it as it could be a high volume or low volume. It doesn't really matter. To me, I can pretty much figure it out on the basis of what a 620 chart is doing. to find the turn. But notice how Apollo Networks, you gap down. That looks like a shortable gap down. In this market, though, that doesn't necessarily go lower. But if you tested it on the short side, you would probably want to set your stop somewhere around this low, because once you undercut this low, which you do barely by, I think, about 20-something cents, you can rally back up. So that actually becomes a fairly tradable move, and you get not quite 10% from here to here if you're looking at that. Even look at Apple, for example. When it undercut, you had all these lows from January and February. So when it undercut that here, look at the heavy volume. Everybody thinks that is a bust of support, and therefore it's automatically going lower. Yes, again, that turns into a undercut and rally, and kind of like more like say a cross between Wyckoff's Spring and Livermore's Shakeout-Plus-Three, which O'Neill turned into a Shakeout-Plus-N, where N is a number of points dependent on the price of the stock. My view is you can take a more precise view rather than coming up with some magic number of points, and that would be, move back above the prior low might set you in motion to buy using that low as your stop. So, there's a practical way to handle this, I think, that doesn't rely on some fixed number of points as if there's a magic number of points where it suddenly becomes a buy signal. Livermore used 3 points, but the one thing that O'Neill never talks about is that if you read Livermore's book, How to Trade in Stocks, he actually talks about a stock making a new low, and when it undercuts the low by 3 points or more and then turns back above that initial low by 3 points, he'll buy it. Now that rule might have worked when Livermore was trading. I think in this market it's quite a bit different, but it is one type of setup that you can use. I'll show you another setup that I bought the other day, and I'm always watching for these. I think about a week ago, we probably were talking about cloud stocks, and there was something of a wolf pack move developing in cloud stocks. You've seen a number of them rallying lately, and this one was pretty strong. Splunk was strong ahead of earnings. When they came out with earnings, the report was actually pretty good on a relative basis, and the stock gapped down, but I was watching this for a reversal on an intraday basis and picked shares up at 52.33, and the stock has run up 4 days in a row since then. It actually was up 13 days in a row, I believe. 1, 2, 3, 4, 5, 6, 7, yeah, 13 days in a row yesterday. So it's entitled to a pullback. Now I'd be watching this thing coming in either to the 10-day or the 200-day line, depending on how the sell-off plays out. Another one was yesterday was Workday, which actually opened down right at the 200-day line. So as soon as it's getting down to the 200-day line, I'll watch this on a 620 chart, and this becomes key in my assessment of stocks on an intraday basis. So let's look at this. This would have been, what was yesterday, 6.2? So this is today.
Yeah.
Okay, here's yesterday. So you opened down, where did you open down? Is this the right, am I looking at this, where is it? Does this sit here? No. Stock got as low as 73.50, so I'm looking for this on 73. This is not it. Down here we go. Here you are. I believe this is after hours, and then it opens up the next day, which would be 6. Today's 6.2. Yeah, so it was 6. I'm sorry, it's 6.1 actually that this happened. So when it opens up, it's already turning, and it blips down to like 73, 72 cents yesterday, and then it turns. So you're getting a buy signal here, and you can come after it, and it holds that, and it's moved higher ever since. But in this sense, the earnings report creates an opportunity in a stock that's been trying to rally. And if you're seeing, I kind of put this together with the fact that you're seeing Salesforce had a viable gap up. It slowly moved higher, but I think you'd be watching a pullback into the 20-day line here. You have Now, which is another one that I played. You had 2 pocket pivots. I think we talked about this last week. 2 pocket pivots here along the 20-day line, and now you've moved higher. Now I'd be watching the pullback into the 200-day line. So I actually bought this, and then I sell into that because I'm getting not 7, 8, 9, 10%. And you're sort of watching also where the indexes are. So when the indexes start coming up here, I'm starting to look a little bit like I might want to take some profits in some of these extended moves. And you have that one, and then you even have let's go to Zen, Now and Zen. I thought that was a good pun. But you had a pocket pivot here 3 days ago. I don't know if you guys can see that. Let me get my handy dandy pen here. But you had the pocket pivot here, right here. and it was very subtle, boom, and then the next day it blasts higher, and that's actually holding tight today in spite of the funky market action. So that's actually acting pretty well, and that's a smaller cloud-related name. You can kind of, they all do slightly different things, but it's all related to the cloud. And there are a number of other ones that are looking strong. You see NetSuite broke out yesterday, so there's a breakout. It had a pocket pivot 3 days ago. Stock has no earnings, but it's a big name in the cloud space, and it's another one trying to turn off the lows. And these sorts of patterns have worked, even though historically these sorts of V-shaped patterns on the weekly chart, and I've talked about this before, tend to be failure prone. But in this market, it seems like they hold up pretty well, which I think is a little bit different than what we've seen in the past. But I think in this market, you really have to be paying close attention to what is or isn't working, not what you think should or shouldn't be working based on what happened 20 years ago. I think that's one of the big failings of Can Slim right now. And then maybe someday Can Slim will work again, but I think you're going to need more of a secular type of bull market where you're seeing money flows, consistent money flows based on some demographic, such as the baby boomers having to invest in for retirement starting in the 90s, which fueled that whole bull market. And you don't have that anymore. So, we may get more of a Can Slim market when you start seeing something like that, and I'm not sure when that happens. In the meantime, a lot of setups are quite a bit different than they have been historically. And I have to admit I'm surprised, but at least I maintain an open mind about it, and I let the market tell me what is working. I don't tell the market what's going to work and what isn't. I might have to make a couple of mistakes in the process, in the learning process, but for the most part, I think you really have to pay attention to what works and what methods work. And so using alternative buy points or even going after stocks that don't have big earnings, and using Shakeout-Plus-Three or undercut and rally type setups, Wyckoff Springs, whatever, those give you more options in a market that's a little funkier, and you're swing trading it. So swing trading does open up a whole new world of buy setups, and I think people should learn these. I would definitely suggest reading all of Wyckoff's books. I think there's another. You can also go to stockcharts.com. They have a great section on Wyckoff. I think it's really good, and it's free. And they do a great job of describing all the different setups that he has talked about. So you have NetSuite. Look at this, HubSpot. I love this one. Here's a breakout. Okay, and that's a cheesy no. I think they're making money. I don't know. Check that one for me, Dr. But here's another one of these V-shaped moves, but it's working. And in the past this would not work. What's that?
Yeah, negative out for a while. Their sales have been pretty robust, but now
they're not making any money. A lot of these are like that. I think Now is one that's making money. I think Workday is making money now, I believe. CRM, Splunk, I think they're still losing money, but that's had a great move. So it needs to pull back. So what I would be looking at on all of these when they're extended is I'm watching these pullbacks into potential areas of support, because I like this group. It's acting well, and I think it is thematically sound in the sense that it does have a foundation for growth going forward, and it's just a matter of this economy opening up and getting something going. So other ones in that group, let me see. You guys got any favorite ones? Adobe, here's another one. This one's actually acting pretty well. It's pulled into the 20-day line. That brings it into a viable position. Here you have a breakout on about average volume, so this would not be a typical Can Slim breakout. Now notice it's running into resistance at the 100 level. So they came out with earnings, I think, on the 21st in about 3 weeks, a little less than that. And I'd be looking for some kind of move through the 100 price level with some authority. You're not getting that, but the pullback might become viable. So you kind of got to keep an eye on that, because that might become actionable. I've got my eye on a whole bunch of stocks right now, and I'm watching them come in. I like the LinkedIn. I think we've talked about before. I'm going to try and scale this a little bit different. Okay, watch your eyes here. This might freak you out. There we go. Boom. See that? You can scale a little differently, and you can see the action a little bit better. Well, not a little bit better, quite a bit better. So you have a pullback here. You have this initial move up on the earnings announcement in late April, and it closes near the lows, tries to go hard, then it comes in. I think the market was coming in a little bit at that time as well. Is that true? In late April? Yeah, it was coming in. So it comes in with the market, and it bottoms with the market roughly. See, the market bottoms in the early part of May. LinkedIn comes into the 20-day moving average. So this also helps to illustrate how when the market is pulling back, you want to be cognizant of where your stocks are on their chart positions relative to where the market is. If the market tries to bottom and you're seeing LinkedIn, a stock like LinkedIn, and this one's one I've liked as a potential turnaround situation, you're seeing it come into the 20-day line on very light volume, then you can take a stab at it and or take a shot at it. I don't like the term stab, sounds too random, but take a shot at it and see if it works. And the thing turns around and it has a 10% move over the next 2 days. That's great time value for a trade. So you could bag that. It comes into the 10-day line again on light volume, declining volume rather here. And I don't know how, it's lighter, but it's not as much. But it comes right in. You could try it again there in another trade. And it comes back to the 20-day line. Volume dries up right here. You can see this. Let me just point this out to you guys right here. There, that's a relatively pretty arrow. I don't know. I'm going to have to work on my arrows. But very light volume there. It's less than minus 50% below average. And you could buy it there. It turns around and breaks out to new highs. You get strong volume on the breakout here. So that looks pretty good. Now today you pull into the 10-day line. Now you're pulling into an area where it may be buyable. So watching this market, if we get some kind of a turn off the lows or it holds up, this could be a spot to come in. The other option is just to come in here and then you can use the 10-day line at 131.31, 2% lower. I think less than 2% lower as your stop. So, you want to be opportunistic, I think. And the idea also is don't get caught in a long position. The idea of buying on a pullback is that you're going to buy as close to an area of support as possible, and that area of support in turn will serve as your downside selling guide or your stop, whatever. I got a question today. Someone's asking, well, do you set your stops right at the moving average or just below? It all boils down to getting rid of this idea or clearing your head of this idea that there are magic stops, because there are none. Stocks can undercut moving averages slightly. You can see, for example, here, in here, and in here, LinkedIn undercuts the 20-day slightly. And sometimes I'll give it a little bit of room, but a lot of times I may be selling and then coming back. I may buy and sell it a couple of times before I get in, and I like the way it's settling in. But there's no magic stop. You have to decide ahead of time how much you're willing to lose. But at the same time, you also have to be willing to determine, okay, if I'm stopped out initially, what sort of action will bring me back in? People want to marry stocks, and I don't really marry them. I date them on a very, very casual basis, especially in this market. And I'm quick to unload things if they aren't working, but I'm also quick to come back to them if I see them start to recover or stabilize. Okay, and that can happen. And I think you do have to be open to that in this market. Can't be rigid. And I hate to say it, the whole canceling mentality just doesn't work anymore. But there are moves you can play, and I think a lot of these stocks show that. You just have to be willing to accept lower profits. But remember, if you're looking to catch a 10, 15, if you're real lucky, 20% profit, here's one that I played recently. And again, the voodoo concept comes in very handy. Just real quickly, you can see right in here on this day, which is corresponds to this day here, it's a very tight action along the moving averages. The volume dries up very, very low. In fact, it's the lowest in this whole base. And you buy the stock right there in the next couple of days, and it actually gives you a couple of chances to come in. And then it breaks out. And so here's a breakout right here that's working. And you could buy that. It's still going up. Stock's actually up again today in the face of a market sell-off, which I think is pretty good. But you get the idea here that if you're playing for 10 to 15% moves, what does that mean? You can't use a 6 to 7% downside stop because your risk reward just doesn't line up properly. You can't be taking 6, 7, 8% losses while you're trying to take 10% gains. The math just doesn't work for you. But if you're buying a voodoo pullback right here, as I've shown you in here in this area here, okay, you have your ready references. You can either use the lows here, or this low if you want, or you can use a 50-day line here. My preference would be to just maybe give it another couple of percent below the 20-day line, and then use that as my stop. So you're keeping it very tight. But let's say if you did use a 20-day line here and you got stopped out on this day. Let's reverse. So let's see, where would you get to? Well, you actually wouldn't have gotten stopped out anywhere here if you're using the 20. So you could use the 28 line, but let's say you had and it shook out a little bit. Well, you could sell, but then you could come back in if it recovered above the 20-day line. So the point is to catch this move. Okay, I don't really care about these little wiggles in here. I'm more interested in catching a nice move. And if I can get a 10, 15, if I'm lucky, a 20% profit or better in a stock, then I'm certainly going to look to take that. And in this case, with the Weibo, which is the Chinese Twitter, hopefully it doesn't become like the American Twitter, which seems to be languishing. If you get that kind of move, you could look at taking it and then looking to buy back on a pullback in, say, the 10-day line, which is rising very rapidly, or the 20-day line. So, and these are essential swing trading techniques that I use. It's not precise, but I think you can get a sense based on where the indexes are. So, you know, if this thing's up here and your indexes are, you know, up near their highs over here, then you might get a sense that, okay, maybe I can take some profits and look to come back in on a pullback. So anyways, let me just cleaned up again. Real quick question here. Somebody's asking about Infosys. I don't really see that as being in any position to buy here. So it's sort of choppy, but it had a gap up here. I wouldn't call that's not a buyable gap up because the volume is too low. But it might pull into the 10-day moving average, and that might give you a lower risk entry point. Not really. This is an outsourcing name, so I don't consider it a cloud name per se. So not really one that I'm all that interested in. So let's see. But I've gone through all the major cloud names that I like, and then of course Amazon is probably the big stock cloud name, and it's continuing to act well. The pullback here is very minimal. I think if it got to the 10-day line at 713.07 now, it might be viable, but you'd have to watch and see how the market's acting. If the market comes off and starts to roll over again, then you probably got some issues and may need to pull back more. So, but you're watching, you know, these things as they come in, and if the market's going to come all the way back to the 50-day, now we're seeing the Dow break below 100 points, down 102 now. It did rally back up to minus 70 something, I believe. Then these things are going to come in. So you got to watch your entries here. AMWD. Yeah, that's done. So I think if you saw this gap down, I mean, there's a pocket pivot breakup, but again, I think it's really silly to try and buy strength like that. You know, oh, here's a pocket pivot breakup, let's buy it. I think as soon as it gaps down, you're gone. So you're going to be out of pocket there a good 6% or so on the gap down. Did they come out with earnings? Is that what happened? So, but you know, you'd be out immediately on the gap down, and to me, this is kind of a cheesy little name. I don't know. I don't really like it. It trades what 185,000 shares a day. It's just too small and not really that exciting to me. I like give me bigger stocks any day of the week. So, anyways. We're down 91, so the market's trying to bounce back. Other names that I've been looking at and playing alongside is Mobileye. You know, you had a pocket pivot here, I believe, right along the 50-day moving average. You get a little pullback here. It holds a 10-day, and then you get another big pocket pivot on Tuesday, and you could have come into the stock there. It runs up to the 40-week line, 200-day line here, actually, which actually was the 40-week line. You see how it actually ran into that and just got a little past it, and it's coming up into this area of overhead, so you can draw a line across here. I don't know if I like this color. This color doesn't really work for me. Let's try something else. So you got some overhead there, and so you could sell into that. But you know, you get a few percent out of that. That's a nice move, coming from about 36.50 up to, what was this, almost 40. So that's close to 10% in a few days. 3 days. That's great time value for a trade, I think. But that's the type of stuff that I'm looking for. That's one of them. I'd also look at I think they need to make this pen easier to use. There's probably some keyboard strokes you can use to work this, but I don't know them yet. I'll have to take the seminar or the webinar for using GoToWebinar. In any case, I'm watching Tesla here. This is kind of looking like a short. I don't know, long or short. You have the pullback in here after you break down. They priced a secondary offering at 215, think it was 9.5 million shares. Okay, now we're starting to see a little bit of lift now off the lows. So you retested the lows, you're starting to turn. That doesn't look too bad. Come on now, let's see what happens here. Just checking my stocks real quick here. Facebook's not really I'm looking at CyberArk's another one, CRM, now Splunk. Nothing really pushing off the lows here. Mobileye, LinkedIn still hanging down there. We'll look at some of these in real time in a little bit. But you have a voodoo day here, volume dry up in the extreme. I think it was minus 63 or 53, 58%. No, 67 I think it was. In any case, it looks like the pullback might be viable. It actually was above it was around 221 this morning in the face of a market sell-off. But now it's kind of reversing. So you got to watch this one. This is tricky. It could be a short here if the market continues getting weak, you might look at it as a short here using the 200-day line as your stop. So any other amazing questions? Let's see. BSX. Yeah, that one's hanging in there, but you had a pocket pivot a few days ago. I think you got to buy it off the 10-day line or the 20-day line. Electronic Arts, EA, holds the 10-day line. If you want to try and buy it at the 10-day line, you could, but my thinking is the closer you can buy it to this viable gap-up day here, back in the early part of May, is better. So this pullback a couple weeks ago is better. Here, you can buy it at the 10-day line, I guess, but if you're entering for the first time and you're not working a prior position or you haven't taken profits, say, up at the highs, then I think it's a little riskier here. If the market rallies, it might come off, but it's a little bit obvious here. On the weekly chart, this is what it looks like. You probably still have some more work you need to do. So my preference would be to buy a pullback to the 20-day. But, if you're looking for us to tell you should be buying it here, I think that's kind of silly, but you do have a pullback to the 10-day line. My preference, though, would be to buy it at the 20-day line. Be more opportunistic. There's plenty of stocks out there that give you chances to buy them. You just have to wait. And they come. So, all right, let's see here. What's going on? Down 70, 71. I don't know. I think they may be baiting longs right now. That's what it kind of feels like, because I'm not really getting any sense of thrust in certain names. Like, look at the markets come back up, for example. Let's just look at this real quickly. ATVI at the 20-day, maybe that's viable there. So you could take a shot, but the low of the day would probably be your stop. Or you might wait for it to undercut this low. That's a possibility. But let's look at what's going on here on an intraday basis. Here we go. Let's look at Facebook. So Facebook's actually coming in as the Nasdaq's trying to rally. So you're getting some lift off the lows, but a name like Facebook isn't really getting any lift here. I don't know if this brings it into a better, spot to try and pick up some shares. Now it's trying to come off the lows. Splunk is making lower lows. That's not really rallying yet. Workday seems to be holding up the best. Salesforce, these are all still kind of in 620 sell mode, so you can see that everything is still sitting below, you have the 6 period sitting below the 20 period. So in my book, that means you're not really turning yet. The rally's back into the 20 period lines, and a lot of these may simply be setting up intraday entries. And you can see this is failing on the short side. So let's look at, say, Apple. That's sort of trying to fail, but it doesn't really know what it wants to do. Here's one I shorted this morning on the opening because they opened it up. It was Baidu, and it's come in and it's continuing lower. So you're getting to a point though where it's a MACD stretch, so it might be short-term coverable. But that's a pretty ugly pattern after the failure. Look at this huge volume failure at the 50-day. It actually had a pocket pivot coming up. But see, one of the problems with this, comes up through the 50-day line on a pocket pivot, and one of the problems here is that it's extended. So it's having a pocket pivot after it's been pretty extended. You might consider this pocket pivot at not enough days. I think 1, 2, 3, 4, 5. It's like the 9th day, I think, here. And now you're busting down to the 200-day line. You're right at the 200-day line, and notice how you're getting a MACD stretch. Your MACD lines down here are getting stretched to the downside. So I've covered this because you're seeing this stretch here and you're down to the 200-day line on the daily chart. So that's come down quite a ways. I shorted up like 176.50, I think it was, right off the opening as soon as it started to reverse, and it's come down pretty nicely. But now that you have the MACD stretch here, I think it becomes shortable, and you take your profit and walk away. And that helps on a day like today, because if you pick up some profits on the shorts, and I'm actually up on the day, and that's because I hit some shorts. Some of my longs, the shorts allowed me to sit with the longs and let them come back up and unload, shares at a higher price, and so you get out a little easier. If I wanted to sit with some longs, I could have probably done that. Maybe workday would be one, but not really clear. So the market's still chopping around, and it's still early in the day, so you could still sell off. Let's see. I like what I've been seeing in some of the cybersecurity names. So you can see here, this had pocket pivots down in here, CyberArk, and it's cruised higher. And on the day that Palo Alto Networks came out with earnings, it pinched down to the 10-day line and then rallied from there. You had a pocket pivot on Tuesday. You see that 4 days ago. And the stock has gone higher. Now it's kind of tracking sideways. That's actually acting pretty well. So Fortinet's another one. It actually was drawing up along the 10 days. So you're getting some voodoo action along the 10-day line here. And it's kind of moseyed higher on light volume. It also sold off last Friday on Palo Alto Networks earnings bust. But with Palo Alto Networks staging a big undercut and rally, the whole group has turned higher. So the better acting stocks actually held their uptrends, which are more roundabout uptrends, and they've all gone higher. Now, Fortinet is hanging in there, and probably a pullback in the 10-day might bring it into viable range, so that's something to look at. I also like FireEye, which is trying to turn here. You got a big pocket pivot off the 20-day line, and it actually was able to continue higher. It's a little bit choppy, but it's continued higher, and now it's above the 50-day line, but you're running into the underside of this base here, so that might present some resistance. But I noticed this whole group is turning, and I think cybersecurity along with the cloud, those are compelling themes if we had a continued market rally. But right now, it just seems to be in this big choppy range. And now that we're near the highs again for the year, that might just put you in position for a pullback here. So, Ambarella, well, you have a gap up move today. I don't know if you want to treat this as a buyable gap up or a shortable gap up. It's at the top of the range, so not really clear. You're so far down there, it's not. I think there's too much overhead probably. The one that might be better would be Broadcom. So that's had a buyable gap up. The low here is 161.20. You're trading at 163.18. So that might be something to look at. So market's trying to turn here down to 67. So looking a little better. Watch Facebook here. Let's see. Let's take a look. I think Facebook looks like, I don't know what this big bar here is, but you can take that out because I don't think it may have gotten up to about 120, but this is a misprint, I think. And the stock's just holding tight here. What's your volume level on this one today, Dr. K? You know? Let me check on mine.
Facebook, minus 19%.
So it's drying up. You're not getting heavy selling, so it's probably coming into position to be bought in here. This actually looks okay. That looks... market's trying to turn, so still kind of sluggish on some of these names. I don't know. Dow is down the least, and Nasdaq's down 0.75%, 0.75%, so not really clear to me what that means, if anything. The Momo names are the ones pulling in right now. So any other questions on stocks here?
Nasdaq's been dragging. It's certainly been underperforming S&P and the Dow.
Yeah, I want to take a look at something here. Let's look at...
Did you hear what I said?
What's that? What?
I was just saying that the S&P and the Dow are only like 1% off their highs, while the Nasdaq's been lagging, and it's about more than 5% off its high right now.
Huh,
so,
okay. Yeah, the Dow is holding up better. Maybe they're buying big cap names, sort of defensive.
Well, it's interesting. The Dow's become more of this international index because of all this QE money printing that goes on, and the capital finds its way often into Dow stocks because those are the most blue chip. So in that sense, I'm more of an index that I pay attention to these days because it just kind of shows those kinds of money flows going on, and the fact that the Dow is showing quite a bit of resilience and strength relative to the other indices, I think speaks to that. So, as QE, the ECB announced the other day that things are certainly not good economically and that they're going to have to relax rates once again. Therefore, the QE spigot's going to continue to pump money into the system. And, I think that just means that the Dow can be more of a direct recipient of that kind of money.
Yeah, and I think that it's less effective, and I think that's starting to become pretty plain to everybody. Is that the whole QE game is really not as effective as it was in the past. So there's sort of a double-edged sword there. Anyway.
Yeah, that's why we're going to have more volatility. And that's a good thing. It's better to have volatility than dull markets like we know about from the 70s when Bill talked about those excruciatingly painful dry markets where you just didn't have liquidity or movement.
Somebody's asking Google short. I guess you could try and short it using the 50-day line as a stop, but it's not clear to me that you're going to make a lot of money short. I see shorting here as more of a tactical sort of occurrence. So, I'm not necessarily willing to short something that's already down. You had to come after something like a Baidu this morning when it was up, which looks like a better position. Some of these other ones like CCL, that looks a little bit, when it was up in here, that was working. But Disney, let's see, they're not really, if you notice, they're not really coming in. Home Depot, not really coming in. So it may be giving you some indication that the market wants to turn here. That's a possibility. So, and I'm watching my 620s here across the board because you might start to see something blossom here, but not really clear. This could be a sucker rally and then they're going to hit it later in the day. So I'm kind of laying back right now. I've taken short profits, backed away from some of my longs and holding cash right here, looking to see what I might want to do. But it's not really clear because the market is in a position, as you said, to pull back more. VMware, yeah, that's been moving higher, but you had to buy it in here, I guess, along the 10-day line when you had the voodoo pullbacks in here. So it's extended now. I think with most of these, what you're looking for is some sort of a viable pullback. And so I'd be looking around for where these might be occurring. Or you're watching the 620. So I'm looking at a bunch of things now. Let's see. Facebook. Yeah, still not. It might be trying to turn. I don't know. I was watching Mobilize trying to punch here. That one's pushing higher. Hard to say though. LinkedIn. See, some of these are trying to turn, but they're running up to their intraday highs right now. Their prior highs here. You can see that on a lot of these. Splunk is continuing lower, so that's not looking so hot. Facebook. Not all that thrilling. Sales are same sort of situation, but not really getting anything definitive here. But it's okay to hang back and wait. You don't have to jump on every pullback as something that you have to buy into in a big way. I think for the most part, just be patient and not jump the gun. So it's still early in the day, so it's only 8:46 my time, so we still got most of the day to go. So more than half of it. Let's see, any other questions? Run through some more stocks. MXL hit the 10-day line, so that's not too bad. I'd like to see it come down lower to the 20-day line. Some other ones that we've been looking at, you can see that all the metal stocks have gapped up today, and I'm not sure what. Yesterday I didn't see this move up. I don't. That doesn't look right. The stock closed down here along the 50-day line, and I'm not sure what this is. Yesterday showing a move up because there's no volume here, so something's wrong. Let me take a look at it over here. Whoops. Let's see. Yeah, see how it was down here? You can actually see it here. It was down along the 50-day line yesterday, and it's gapped up today. And you're seeing that action in a number of these stocks. Agnico Eagle Mines is another one. You've seen it. So do you treat these as viable gap ups, Dr. K?
Let me just see this one. I mean, the thing with these is they're, it's had a lot of momentum. So, some of these they're kind of gray areas because they're commodities. And they tend to often trade pretty sloppy, and they're ruled by really the direction of commodities, which isn't always a very, like with oil, we've seen that a lot of oil stocks trade very sloppy. And
Yeah.
so, I mean, technically it is a viable gap up, and we're seeing gold. Gold has been on overall anyway. It's been on certainly an uptrend. Precious metals, as I said at the beginning of the broadcast, have been doing well over the last several months. So have all commodities, and so given that premise, and I believe oil is going to continue its uptrend as well. It kind of puts it in favor that a stock like this could be placed on the list.
Yeah. Somebody's asking you, please interpret price volume action on UVXY. My initial response would be that UVXY is a derivative of volatility, and I don't think volume necessarily is relevant to the UVXY. Dr. K, your thoughts? So basically, here's the question. Here's a question for you. You ready? Please interpret price volume action on the UVXY. S&P 500 resistance at 2100, but ETF seems to be dropping in disproportionate amount.
Yeah, I'll just say for the record, the VIX volatility model is not looking at price volume action of these derivative indices, rather these derivative ETFs. It doesn't help the model in any way to look at that. I mean, there might be something useful, but it's not something that I've found to be useful to the model. So, again, that doesn't mean there's not useful data in there. It just means that for the model's purposes, it doesn't gain any advantage to examining price volume structures of UVXY, XIB, etc. Now that said, I will say that there are everything's always in context. So sometimes what the model will pick up is the XIB. It could be the UVXY, whatever, because these all correlate to some extent. What will happen sometimes is that with a rising S&P, the XIB should rise as well, and UVXY, of course, will go lower. Sometimes there's drag. In other words, sometimes there's the markets will go higher, but the XIB won't over a short period of time, and so that's valuable information for the model in terms of in context with certain situations. And vice versa, of course. It can happen like it did in 2015 when I was running my tests, and this is before it went to beta in August, but throughout those prior months, XIB did very well. The model did very well, shockingly. I didn't think that it would, but yet if you look at the XIB chart, in the earlier part, the first half of 2015, you'll see that XIB did very well relative to the S&P, which was more or less sideways. And I'd seen this before, but this was a very pronounced effect, which, again, that the model does take these sorts of situations into account. But if you just take price volume on its own, there's not a lot of help that is offered for the model.
Yeah, that would be my impression as well, that it's not really that relevant. So, anyways, Dow's trying to rally back, and Nasdaq's not really budging too much off its lows. Let's take a look here. It's trying to rally somewhat off the lows. You haven't really had a 620 turn yet, but it's trying to find a bottom. So it's looking like it might turn into a viable pullback. So I think we covered several names here that look interesting on the pullback, but you definitely want to be watching support levels. Let's see here. Yeah, still kind of nothing really thrusting real hard. One of the things you'll notice is when the market does turn, you'll see a lot of stocks start to turn on very, very rapidly, and so everything turns turns quickly and you see the volume pick up on the upside. It seems like you're drifting higher, and everybody's sort of treating it like a viable pullback, but they could be baiting them. It's not really clear. So I'm more content to hang back and see where things go from here. So anyways, any other questions? Otherwise, I'm inclined to wrap things up. But I'd go through our list of pocket pivots and viable gap ups. We put out the spreadsheet over the weekend, and you can go through that and look and see what that makes a reasonable buy watch list. And some of the names that I've talked about on the webinar, you can look at those as potential buy ideas and watching where they're pulling into on their charts. And I would just keep track of those. They use your 620 chart and see where you might start to pick up some turns. I'm still looking around, not seeing anything definitive again, so it's sort of neither here nor there. Anyways, somebody says, have you created a VDU filter in HCSI? Well, it's really easy to create a VDU filter. You just make intraday volume less than or equal to minus 35%, and then you can just screen that over your buy watch list or your short watch list or whatever, and then go that way. It's a pretty simple screen to create. So yeah, I have one. I created it, but it seems kind of silly to create a canned one for everybody because it's a pretty basic idea. If the intraday volume is running minus 35% below average or less, then you can consider that to be approaching voodoo volume levels. So that's really all you need to do, Scotty. So you know that, though. Anyways, I did want to bring up one thing and just pay tribute to a friend that passed away over the weekend. I don't know if any of you know who Ian Woodward is, but I consider him a second mentor. He passed away on, I believe, Saturday at the age of 84. His wife had passed away last summer. And my sense was that, being married for 6 years, that sort of pushed him towards going to join his wife. I think there's something to that when couples who've been together for a long time, one of the partners passes away, the other one doesn't go too far later. But Ian was having some health issues, but a brilliant guy. Dr. K, you've met him a couple of times, and I knew him pretty well. Ian was very open to our work, and he started out, I think, at Telescan way back in the 80s and 90s, and just had incredible insights about the market. And to me, he was sort of a second mentor, and I just wanted to note that he did pass away Saturday, and we are going to miss him badly. I was talking to Ron Brown yesterday, who used to talk to Ian every day on Skype, and it's sort of a big hole for him now. But I'm sure he'll carry on, as we all will. And but he was just, I really loved Ian. He was such a gentleman. Just such grace, such class, and I loved his gravelly, he was British and grew up in Britain. In fact, he was telling us how when he first started dating his wife, he lived near where your flat was, over in, I guess, Piccadilly Square over there, Dr. K, when you were in London. And he had this gravelly voice that was not really an English accent or British accent. It was sort of like Californiaized because he lived in Palos Verdes over here. And then I spoke with him at length on the phone the day before he moved to Austin, Texas, where he was going to a elderly care place, a very nice one, actually, in Austin, Texas, where his son lives. And we had a nice long chat, and I told him that if they decided to have any HDS investor workshops or conferences in Austin, I would be happy to fly out for that. Previously, they would have them here in Palos Verdes, which is down the road from me, basically about a 20-30 minute drive. And I did that twice a year, and I really enjoyed it, and I'm going to definitely miss doing that. It was something I look forward to. I met a lot of great people. I know some of you are probably on this webinar, but I met a lot of great people there, a lot of great traders. And so we're kind of losing things in terms of these old masters that I've known. Bill O'Neill, I've heard, is suffering from dementia, so he's basically out of the picture. And now Ian is gone. And for me, it's a little bit sad. But at the same time, life goes on. All things pass. Nothing lasts forever. And it sort of reminds you of that. So the basic message is, we're all very lucky to be here trading in the markets today, and I think that it's we don't realize how lucky we are and how short our time is here. So make the most of it and make sure you have a good time. I know Ian did, and just a class act, and I just wanted to note that as closure to today's webinar. So, anything else?
Very well said. Very well said.
Anyways, you guys, good luck today. Hopefully I've given you a nice outline for how to approach the day today, and we'll catch you next week. Have a great weekend. Ciao.
Take care, everyone.